We need to talk about a report that I genuinely do not understand why more people don't pay attention to it. You're never going to see this trend on social media. Half the time, even the big financial programs barely mention it. Every time the economy turns, though, this thing is already there and it is predicting what's about to happen. I'm talking about the ISM Manufacturing PMI. Certainly not flashy. You may have never heard of it. It is not dramatic, but it is one of the most reliable early indicators that we have. And the latest reading, which just came out, it just added to a trend that I say we simply can't ignore any longer, even if most other people, those who don't watch this video, are still going to do. The U.S. manufacturing sector has now contracted for 9 consecutive months. So that is already a long stretch. Even more important than that, though, is the trajectory that we're seeing. When you look at the PMI chart for 2025, the trend is clear. It is a staircase, and it's heading down. Manufacturing peaked early in the year, slumped into the spring, steadied for a little bit in the summer there. Now it's rolled over again into November. And this is what a slow loss of economic momentum looks like. It's steady, it's persistent, and it's easy to ignore until it sort of steps up and smacks you right in the face. Now, I do want to break down the structure of the PMI itself just to help you understand how important this is. The PMI is built from 5 specific components: new orders, production, employment, supplier deliveries, and inventories. And in this month's report, 4 of those 5 are contracting. New orders, they're contracting. Employment, down. Supplier deliveries are contracting. Inventories are contracting. Only production is still in expansion territory. It nudged up a little bit to 51.4. So even before we look at anything else, the core building blocks of the PMI are all pointing in the same direction, and that is weakness. But then when you look at the broader table, the picture is even clearer. When you look beyond those 5 PMI components, most of the other sub-indexes, backlogs, imports, export orders, they're also contracting. What we're seeing here is a broad coordinated weakness across the sector. Let's walk through some of the most important pieces, starting with the employment index. It fell to 44, and that is the 10th straight month of contraction. According to the ISM, 67% of manufacturers say that managing headcounts, which means hiring freezes or slow reductions, is their current norm. I will acknowledge here that manufacturing jobs are a smaller slice of the US economy in modern times here, but they do still act as a very good early cycle signal. That's what this report is telling us. When companies avoid hiring for 10 straight months, let's just say they're not expecting a major surge in demand. Next, I want to look at new orders, which fell to 47.4%. Now, new orders, this is one of the most forward-looking parts of the PMI because it tells us what the customers are actually asking for. What have we just seen? Well, we have seen weak orders. We've seen weak hiring. We just looked at that. So when we look at those together, they create a very specific picture. It is a picture of companies that are preparing for leaner times in the months ahead. Now, let's add another layer to that. The backlog fell. It fell sharply down to 44. And if you look at the chart in the ISM report, that decline has been steady throughout the year. There are 18 industries and only 3 reported growth in backlog orders in November: electrical equipment, appliances and components, food, beverage and tobacco products, and fabricated metal products. Now, 11 industries reported lower backlogs in November. And here's why that's so important. These backlogs, they act as a cushion, right? When new demand slows, companies will keep operating by working through their old orders. Now, when that backlog erodes, though, that buffer disappears. Eventually, production has to catch down, in this case, not up, to match that demand. Now, that takes me to supplier deliveries. The supplier deliveries index fell from 54.2 to 49.3, and that is a big drop. Now, this index actually works backward from what you might reasonably expect. If we look at the ISM survey, a reading of 50, that represents normal delivery speed. Numbers above 50, that means that deliveries are actually slowing. It sounds a bit counterintuitive, but slower deliveries is usually a sign that the suppliers are busy, they're stretched because demand is strong. Numbers below 50, that means that deliveries are speeding up. Now, that can sound good, but it usually happens because suppliers have more free capacity. Why? Because demand is weaker. So when this index drops into the 40s, which is what we're seeing right now, it's not telling us that the supply chains are becoming more efficient. All of a sudden, it is telling us that suppliers aren't as busy. They can ship things faster because fewer people are placing orders. The most important takeaway here is that it means that the weakness isn't just at the factory level. It is also moving upstream through the entire supply chain. Another thing that we need to consider here, customer inventories. They remain too low, according to the report, at 44.7. The only industry reporting customers' inventories as too high in November is electrical equipment, appliances, and components. Now, under normal circumstances, low customer inventories, you think that would be bullish because you would expect restocking. But we just saw a minute ago that the new orders are falling. So low inventories today, it probably means that buyers are just simply being cautious. They aren't rebuilding stock because they don't want to get caught holding excess goods in a slowdown. Now, prices paid rose to 58.5. So that means that manufacturers are still facing higher input costs, even though the demand is weakening. And that's a very unusual combination because think about it. Normally, weak demand, that pushes prices down. But here we're seeing the cost push inflation, topic for an entirely different video, but slowing demand plus rising costs, that's not a scenario that would support any big interest rate cuts, something that a lot of people would like to see. Now, one other thing I want to cover in this video. On page 1 of this month's report, you can see only 4 of the 18 industries reported growth in November. So that means the majority of industries saw no growth at all. 14 industries are contracting. And when you're looking at this type of thing, breadth is very important, right? When contraction becomes widespread across industries, think of chemicals, metals, food, machinery, plastics, transportation equipment, that is usually pointing to a cooling cycle. So what does this mean for investors? I don't think it means that we're in a crisis, at least not yet. We might be moving in that direction, but we are definitely seeing a slow, very broad, very persistent downshift. Weak orders, weak hiring, falling backlogs, faster supplier deliveries, low customer inventories, and combine that all with rising input prices. And when you put this all together, it definitely paints a picture of an economy that is going in the wrong direction. I think if it were an airplane, it would actually be losing altitude. Now, as I mentioned earlier, manufacturing does represent a smaller share of the U.S. economy, but it is still one of the most reliable early indicators. When the PMI shows this kind of pattern, a multi-month downtrend supported by weakness across most of the sub-indexes, I say that we should pay attention. Now, I did not go into and cover the services PMI in this video. That really deserves its very own breakdown. It works differently. It measures different activity. Honestly, though, the insights can be just as interesting. So if you do want to see a video like this on the services PMI, just let me know in the comments below. If there's enough interest, I will put that one together because when you look at these two reports together, that's probably at best when you read them side by side. Now, do you compare your portfolio against the S&P 500 or the NASDAQ? You might want to reconsider that. I will explain what I mean in the video right here. Thank you for watching. We'll see you in the next video.